In this video, traders are going to ask, why am I getting slippage intraday? Stay tuned. Hey guys, warm welcome to you. All right, so I think most people understand the kind of reasons for slippage overnight. You know, if you've got a sell stop here, the market comes down, and let's say it closes here, you're like fine, then overnight it opens up down here, the first available price is down here, you're going to get slippage. But some people say, well, why am I getting slippage intraday? So let's kind of explain that situation, especially with some of the stocks at the moment that are super volatile. People are saying, well, I'm getting really bad fills. Why is this the case? So let's try and explain it on a kind of micro level. So imagine you had a stock, for example, here, right? And you say, okay, you know what, I'm long this stock, but I'm going to put a sell stop at this level, and that's 181, so 181 bucks. And you've got 100 shares, and you put a sell stop in with your broker that basically says, put your sell stop in 181. Now, as you know, what happens when you hit 181? That basically triggers when the price hits 181. Normally, there's a different type of triggers, but generally it's when the bid hits that or when there's a trade goes through at that level, you know, one of those type of things. That then says, hey, this person has got a sell stop at 181, 100 shares, sell 100 shares as a market order. So it converts that order, fires a 100 market sell order into the market as soon as 181 is hit. Fine. So what does that actually mean? So why do we get slippage as well? What does it mean? So basically what happens, you imagine this is the order book, and the order book is basically orders stacked up. So you might have here, you know, someone's sitting on the bid here with, you know, maybe he's got 20 shares. Maybe there's another guy sitting on the bid here with, 10 shares. Maybe there's a guy sitting on the bid here with 200 shares. Maybe this guy's got 1,000 shares. You know, maybe this guy's got 1,000 shares, 500 shares, 100 shares, 5 shares. Just for example, okay? You've got a price and you've got a volume. And it's basically just people like you and I, institutions, anyone saying, hey, you know what? I'm going to sit here and I want to buy this stock at 180.60 and I've got 1,000 shares to buy. So they put themselves in the order book, and that means if the price gets there and someone takes that order, they're filled. And this creates the prices that we see in brokers, in CFD platforms, spread bet platforms, standard brokers, etc. You see this 181.00 to 181.05. If it's a CFD platform or a spread bet, sometimes they'll have a bit extra on, and that's the charge. It's incorporated in the spread. If you're trading kind of direct to the exchange, you may pay a commission on that. And if you've got direct access, you can often put your orders in here as well. But anyway, so this is kind of happening, and it was a very busy stock. It's dynamic. You know, you've got to imagine, you know, stocks being bought, being sold, the order book's being replenished, being filled, being swept, etc. When someone comes in and buys, let's say 1,500 shares here, a market, it basically takes 181.05, 181.10, fills them that, gives them an aggregate price, and the next available price is 181.15. So this is happening all the time. So imagine on the sell side, from the stock perspective, you've got your 100 shares, bang, all of a sudden someone comes along, and imagine the stop is triggered on 181 trading. Someone comes along and they sell, let's say 30 shares, or let's say they sell 40 shares, right? All of a sudden they come along, they've sold 40 shares at market, it's hit the 181, and that's triggered your sell stop. But because this guy had the order in first, it was part of the trigger, he's been filled at 181, 180.79, and he's had the last 10 shares filled at 180.78. And now the best bid is 180.78, and that happens to be the price that's the best bid by the time your market order gets fired into the market, because the 181 that triggered it has already been taken. So that's already been taken by whatever order triggered it. It's swept through. The next available price is 180.78. Your sell stop gets turned into a market sell order. By the time that hits the market, your best bid is 180.78. In this example now, we've got, what did I say, had 40 shares, I think. So you've had the 20 gone, the 10 gone, and that's now 190 shares available. And that's what you'd be stopped at. Your sell order would hit, you get filled 180.78, you take 100 shares, leave 90 left on the bid. And that is why you often get slippage, guys, is because it's not necessarily any shenanigans or unscrupulous nature. It's just literally the fact that the market's moving so much, and by the time your order hits the market, it's not a delay or it's not a poor technology or anything like this. It's literally saying, okay, hey, do you know what? This has been triggered at a certain point, and when that's triggered, just by the nature of the fact that it's traded through it and it's taken that's the order that's caused the trigger. Your order is the next order. then it's going to get executed at a price. And that's something you've got to be aware of in kind of fast markets and quick markets. You can use a stop limit order and say, hey, I'm going to sell stop, but it's going to be a limit at 181, and that would leave a limit in at 181. The disadvantage is you might not get filled on that, but you're not going to pay any less than 181, so you could get stuck in a position you don't want. But I guess the moral of this is just be mindful of the market you're trading, the stock you're trading. You know, how big's the spread? In this case, the spread is 5 cents. It's probably more. It's how liquid is it? In other words, if it's a thick order book, so something like, you know, Apple, thick stock, you know, maybe a lower price stock as well. The lower the price, the thicker it is, because the increments, you know, are more of a percentage move. Like 1 cent on a $10 stock is quite a lot, whereas 1 cent on a $1,000 stock isn't much. So you're going to get much more gaps in the order book, and you're going to get slippage. So slippage is part of the game. The more volatile an instrument, the more slippage you're going to get. The more illiquid the instrument, the more slippage you're going to get. The less volume that's flowing through per day and per minute, the more slippage you're going to get. Part of the game, part of the deal. If it becomes too much of an issue, then maybe trade another instrument, or stagger your orders, or be a bit more mindful about where you're putting your stops. But really, it doesn't become an issue for most swing traders. If you're day trading, it can become an issue. But if you're day trading, maybe you kind of put your orders on the book and taking stuff and working bids and offers anyway. Anyway, guys, that's it. Why am I getting slippage intraday? Hopefully that helps. Take care. Bye-bye.